Welcome everyone to Vested Interest. This is Shane back again from the stock pick of the day video. It is September 9th, Monday, the first trading day of a new week here, already into the second week of September. Boy, the days and the months sure are flying by here in 2024. Today we're going to take a look at Albertsons. This is out of the consumer staple sector. This is a grocery store chain here. Actually, they are in the process. I think Kroger and Albertsons had already come to a merger agreement. So Albertsons is in the process of merging with Kroger, though there are some holdups to that. I know that the government's looking at this as a potential monopoly issue. But we're going to take a look at the company anyway. Albertsons, again, the grocery store. This is out of the consumer staples sector. Before we get too far in the video, if you could do me a favor, hit that thumbs up button down below if you find any value in the content. If you are a dividend growth investor, make sure you subscribe to the channel. Join us on this journey to financial freedom. Join the vested interest community. Hit that subscribe button down below. Make sure you notify your bell is clicked down below. Make sure the notification bell is turned on so you can be aware of any time we post any new content. And drop a comment down below. Let me know what you think of Albertsons and the merger with Kroger. Do you think it's going to go through? Do you think the government's going to put the kibosh in it? I know this one, as well as Google, recently faced some antitrust issues. So they are seemingly looking to crack down on some of these companies that look like they are trying to produce a monopoly. I remember them doing a similar thing back in the late 80s, early 90s, and breaking down or breaking apart some companies that were monopolistic in nature, basically buying up the competition to become one huge conglomerate. I don't know if that's what they're doing with Kroger, but I think that's what the government is looking at. But let's get back to the video here. This is the vested interest stock screener. This is how we're going to run through the video. We'll check this criteria at the end, see how this one stacks up. Must meet 5 of 8 to make it onto my watch list, or 6 of 9 if it was a financial company, such as a bank or an insurance company. Then I add in price to book, using 1 as fair value, anything under 1 undervalued, anything over 1 overvalued. But if you use price to book, which you can for any company you like, outside of financial companies like banks or insurance companies, make sure you're comparing the company's price to book that you are looking at to a company in the same sector creating the same type of products, and then look at their price to book and see which one, how they shake up. You should be looking at more than just price to book as a metric, but that's one way to use it, and you can use it for more than just banks. But like I said, don't use the one. So we'll run through this screen at the end and see how this one stacks up. Now back to Albertsons. Check them out at their homepage, www.albertsons.com. That's www.albertsons.com. That is their homepage where I pulled this information from. In 1939, Joe Albertson, a former Safeway district manager, took $5,000 he saved and $7,500 he borrowed from his wife's aunt, Bertie, and partnered with L.S. Skaggs to open his first Albertsons store on 16th and State Streets in Boise, Idaho. Joe knew the keys of running a really great store, and it was all about working hard for the customers, give them the products they want at a fair price with lots of tender loving care. Joe was innovative too. He had one of the first in-store magazine racks in the country, along with a scratch bakery and fresh ice cream made in store. He worked hard 7 days a week on his vision to build his company, and through his inspiring work ethic and tireless determination to run the best store, the first store thrived. Just 2 years later, he had opened 2 other stores in neighboring communities and grew the fledgling company's sales to over $1 million by the end of 1941. The rest, as they say, is history. Again, Albertsons, a grocery chain. Obviously, they have much more than just the 2 stores that he started back in Boise, Idaho, and they are looking, like I said, to merge with Kroger. Kroger has over the years bought out a lot of grocery chains, so this would just be another one to add under their umbrella. And they do, I'll be honest with you, kind of look like a monopoly as they buy up all the competition. Now, the reason we are taking a look at them, down 2.84% on the day. We are talking about Albertsons companies, ticker ACI, out of the consumer staples sector. Close out the day at $17.94. 52-week range as low as $17.90. So they are right at their 52-week low. As high as $23.77. Market cap of $10.393 billion. A beta of 0.33. So they are less volatile than the overall market. PE is pretty low, 9.35, $9.35 per share. EPS, earnings per share, sitting at $1.92 per share. They have their next earnings date coming up sometime between October 15th and October 21st. Their dividend is 48 cents annually. I think it's 12 cents per share per quarter, but we'll see that here towards the end. They have a starting dividend yield of 2.6%. Ex-dividend date was July 26th. Looks like they paid out on August 9th. So if you were to buy them, you would be in line for their next dividend, though you have to wait a couple months. And I don't know if they do secure this merger and go through with it. I don't know what that'll do to their dividend, whether it will roll into Kroger's, whether they'll continue to pay it on the timeline that they do. That's some information I did not read that far in. I just know I own Kroger in my portfolio. I do not own Albertsons. I just know Kroger because I own Kroger. I keep an eye on that one. I know that they're entering into a merger and trying to buy Albertsons right now. Yahoo Finance does have a one-year target estimate of $24.48, so they do see some upside as far as price appreciation on this one, and that would be a new 52-week high. Jumping over to the right, we're going to take a look at dividend yield theory. To do that, we typically look at their 5-year dividend yield average and compare it to their current 2.6, but since there is not 5 years of data here, we can't do that, and their trailing 12 trailing 12 months here is 2.6 right on the nose. So their dividend yield is right where it's been over the last year. It really hasn't gone anywhere. Payout ratio is low, though, at 25%, so they have a lot of room to continue to increase that dividend, and 2.6 is not a bad starting dividend yield either. So going back to 2022, we're going to look at free cash flow. We want growing free cash flow over time. Typically, if a company has growing free cash flow, they will raise their dividend along the way, be able to pay down debt, make acquisitions, reinvest back into the company. We want growing free cash flow over time. 2020 here, you can see 1.9 billion. 2023 dropped down to 700 billion. So far in 2024, it looked like 628 billion was announced back in February. Over the trailing 12 months, they're at 830 million. 1.9 billion, 700 million, 628 million, and then 830. So they are kind of up and down here, down in 2024. Looks like heading into what they will report out for 2025. And the first quarter there is how it looks like. That's funny That's a funny report out because the trailing 12 months would include all the 2024 and part of 2023. So I don't really like how this is reading out. But either way, that is not growing free cash flow. They have not been repurchasing any shares as of lately. I think the last time they did was way back in 2021. Now jumping over to stockanalysis.com, and I always recommend more than one source so you can make sure the information you are getting is accurate and up to date. Sometimes these sites are behind whenever they're updating it. As you can see here, price targets were last updated on July 23rd here on stockanalysis.com. So this is a few months old now, right? Or a couple months old now, having not been updated since July. But they did have 6 stock analysts that took a look at this back then. They called it a consensus buy, though it is right there on buy and a hold. If you were to go to the webpage, you'd be able to click on each one of these and be able to see how many might call it a strong sell, a hold, a buy, and a strong buy. Only 6 analysts. Most of them must have called it a buy or a strong buy. They do have a low estimate, or did have a low estimate back in July of $22. It currently sits 22.6% lower than that. Average estimate of $24.92 would be a 38.87% increase from where it currently sits. And if it happened to hit their high of $27.25, that would be a 51.85% price appreciation. And if you were to buy them now you could lock in that 2.6% dividend yield. Now, same thing, if you were to buy them now, I don't know what their plan is as far as shares, whether, again, they're going to get rid of the shares of Albertsons and roll over to Kroger, where you'd get so many shares of Kroger compared to how many shares of Albertsons you had. You want to look into that if you were looking to buy this company, especially if that merger goes through. Obviously, if the merger falls apart, that doesn't matter, and you just go on down the road with your Albertsons shares. But there is the potential for this one to be rolled into Kroger. So there may be some shakeup with this company as far as how the shares are paid out, what the dividend will be. All of that may change. I'm not saying it is, but it may whenever the merger with Kroger goes through, if it goes through. Same thing. I'm not saying it's going to go through, but it could. Now, jumping over here to the right, I'd like to take a look at how efficiently a company is reinvesting its capital. To do that, I look at return on equity and return on invested capital. Now, I like 10% or better for both of these metrics. Return on equity, smoking high, 45.57%, very good number, but the return on capital, a little lower than I like it. I like 10% or better and 8.28. It's not egregiously below what I'm looking for, but it is below what I'm looking for, so we wouldn't give them a check for that one. EPS growth forecasted over the next 5 years. I like 5% or better forecasted over the next 5 years. This is sitting at 3.04%, so a little low for me. Revenue growth at 1.98%. It is growing, so that's good. And I will say, grocery companies overall do not have a very high margin. They're not a very high margin business. So EPS, I guess that's not terrible, though it's not quite the 5% I'm looking for. So they are a quarterly payer. Payout ratio, again, very low, 24.98, very low payout ratio. They are not growing the dividend. You can see that going back to 2022, they were paying 12 cents. Looks like they threw in a special dividend back there in 2022, October. Buyback yield, negative 5.45%. So when they do buy back shares, they're not doing it very efficiently. Shareholder yield is negative away. We want that to be positive. Now, they do pay out on the January, November. Oh, well, no, they're not steady here. Let's look at this. May, August, January, November, February, May, August, November. So February, May, August, November. February, May, August, November. It looks like maybe they had the one payout in January was just this special dividend, right? So their typical payouts are February, May, August, November. February, May, August. You'll have another one in November. So again, if you were to buy them now, you would be in line for that November payout if they are going to pay it, if they don't roll this into Kroger and cancel that dividend and pay out on the timelines that Kroger does. We'll see how that shakes out. If anyone's read any more information about this merger, drop it down in the comment section. I'd love to hear from you. I'll probably look up what's going on overall after this video. Whenever I do that, these tend to get too long. So I'm going to pull as much information as I can, but also give these in a manner that you can absorb them pretty quickly throughout your day. So let's jump back over to the screener. Understand the business. That's where we started. Check there. Growing free cash flow up and down. So no check. Growing dividend. It hasn't been growing other than the special dividend back in 2022. Dividend payout ratio is under 75%. Check there. Dividend yield theory. Can't use it. Don't have 5 years. Buy below current cost basis. It actually is within 15%. It's right up against its 52-week low. Check there. Return on invested capital was low. Return on equity was good. I might be splitting these two up and make it, 6 of 9, 7 of 10 for these, and just have those separate. But we'll see. Earnings per share growth equal or greater than the industry or 5% plus. It was not. It's only 3%. So no check. So 1, 2, 3. It would not go on my watch list. Kroger is in my portfolio. So I'm interested in what's going on with this merger and if it's going to go through or not. But this one is not one that would make it onto my watch list or into my portfolio the way it sits. Well, that is it. As always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Join us on this journey to financial freedom. Join the best interest community. I do personally read and respond to the comments. I'm always interested to read your questions, opinions, or suggestions for future topics. I do viewer suggestions. So if you have a company like Albertsons you'd like me to cover in the Stock Pick of the Day series, go ahead and drop it in the comment section down below. And make sure that notification bell is clicked so you can be notified whenever we put out that video. And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by. Thanks for tuning in. Hope you have a great week, and we'll see you in the next one. I am not a financial advisor. Nothing in this presentation should be considered financial advice. I am only sharing my opinion and investing in general educational and entertainment purposes. Investing involves risk and money, so never invest any amount you're not comfortable losing. Always do your own research. Invest based on your situation, circumstances, and selected criteria, or seek the advice and counsel of a certified financial advisor.